Welcome back to the Business Breakdown Adobe. This is part 2 of the series of analysis that I'm doing on the company. If you haven't watched part 1, I would just pause the video right now and go and watch that. It covers the high-level understanding of what the business is and how it makes money, who the customers are. And that's really important to understand before we dive into the financials, because otherwise you're basically just looking at numbers without any real context or foundational understanding of what they mean. This series is not financial advice. I have to put that out there. This is just me sharing my analysis on the business as a CPA and senior financial analyst. But if you want to buy the company, you should definitely do your own research and not listen to me. I will also caveat the video by letting you know that I do own some Adobe stock. I bought a little bit before doing this research because I like the perspective that owning a stock gives me when I'm trying to understand a company. And then most of this work was done when the price was between $240 and $220. And when you're watching this, not only might the price be different, but the entire business landscape could also be different. So take this video for what it is, which is more of a foundational understanding on the company and how you might want to analyze a business rather than being like an up-to-date status of the company. So like I said, this is part 2. We're going to be covering the fundamentals. We're going to look at the income statement, the cash flow statement, and the balance sheet, as well as some valuation metrics and compare those to the peers. And then in future videos, we're going to be looking at the business moat. We're going to be looking at the threats and opportunities that Adobe faces. And then we're going to look at who the management team is and try to understand, are these the right people for managing those threats and opportunities? And then finally, we'll do a quick look at the current valuation and try to understand if it's fair. Okay, so let's jump into it. Now, we are gonna start with the income statement, which not everyone would do, but that's how I wanna do it, because the income statement is really the story of the year and the prior years that you're comparing it to. It tells you what happened over the course of the year, whereas the balance sheet is how the business is at a certain point in time at year end. And I am still building my understanding of the business. So I want to look at the story of how things have been going. We are going to mostly just be looking at fiscal 2025. At the time of recording, Q1 fiscal 26 numbers have been published, but I prefer to look at things from a whole operating period perspective first, and then we can bring in Q1 information as we need to get updated understanding. So let's just start by looking at this chart because I think it's pretty interesting. The tall columns here is revenue, and it's split by the 3 reporting segments that they used to publish up until FY26. So the digital media revenue is in red, their digital experience revenue blue, and then publishing and advertising revenue in orange. Again, if you don't know what those are, go back and watch the first video because we cover that in a lot of detail. Now, the green bar here is their net income. So this is bottom line after all their expenses. And then the purple one here is their gross margin percentage. So this is their revenue less their cost of sales, all the costs that it takes for them to make revenue before operating expenses as a percentage of that revenue. I mean, right off the bat, this just looks good. Revenues going up, net income going up, gross margins expanding to 89%, which is, I mean, even for software, that is really, really good. The one thing I think is kind of interesting to talk through as a teaching moment is looking at some of these numbers here. Again, these are the exact same numbers, but their net income percentage is kind of interesting. Like we had 14% of revenue in December 2023, 2.4% in FY24, and then up to 28% in FY25. Why the fluctuation, right? Like that was the first thing that stood out to me when I looked at this. So it's actually pretty obvious, but I think, again, this is a pretty good teaching moment. So if we pull up the income statement numbers as a percentage of revenue. So you'll see total revenue, 100% of total revenue, and then everything else is a percentage of that. This is sort of one of the easier ways to look into it. So what you'll see year over year is like basically the same, basically the same, basically the same, basically the same, basically the same. Oh, this is very different and also different to the years before. And then everything else basically the same all the way down. So, then we can sort of ask, okay, what is this? Like, why did this happen last year? And if you hop down to the actual income statement that they publish on their site for investors, you can see that this is other operating expenses. So looking at that, we can see that they had an acquisition termination fee of $1 billion in FY24. And if you go and you look at the notes of the financial statements, they paid that $1 billion as a termination fee for the Figma transaction. So if you weren't aware, Adobe tried to acquire Figma in FY24, but it was blocked on non-competitive standing. Basically, the government decided that it would be monopolistic for Adobe to acquire Figma and didn't let it happen. And Adobe had to pay $1 billion to Figma as compensation. So that's what that is. Now, the important part of looking at it like this is that if you think about it, what we're trying to do is understand year over year how effective Adobe is at operating. This acquisition termination fee is what you call a one-time expense. And really what we're saying here is that it's not standard. It doesn't happen every year. And when we're analyzing the business going forward, we got to keep that in mind. Basically, what we should do is adjust it out. So what that means is that the net income in FY24 goes from $5 billion to $6 billion. And then FY25 stays the same, FY23 stays the same. But really what that means is that the net income growth from FY23 to FY24 was a lot higher than what we see. And then the growth from FY24 to FY25 was actually not as high as it looks originally, right? This looks super flattering in the nearest term. Whereas, I mean, this is still quite good. 8.7% is like pretty good by most metrics, but that is a pretty steep downgrade as well. So it's not necessarily like a red flag. I think we need to do a lot more analysis to like understand this, but it's just sort of something to keep in mind, and the importance of looking into some of the things that stand out when you're analyzing a business's fundamentals. So, I mean, that's sort of the story of the income statement. I don't think there's actually that much more interesting here that I want to go into, but more or less, Adobe historically up until FY25, genuinely a fantastic business, growing revenues and gross margins, but the stock is dropping. So we have to ask, what does the stock market see that we don't see in the income statement? That's the key. Everything we're looking at here, basically for the rest of this video, is historic, and it's building our foundation of understanding, but we have to look forward to understand what the market is looking at. And then just, keeping in mind that FY25 results are strong, but probably look better on the surface than reality. And then maybe you might say that there are some questions over the capital allocation and stewardship of the business from the FY24 attempt to acquire Figma, but we're not going to go into that here. Part 2, I want to look at the cash flow statement. This is kind of like a weird order, to be honest, but I feel like when I was doing this analysis, it's the best way to tell the story of at least me getting my understanding on Adobe. So the cash flow statement is kind of like the lie detector. If the income statement is the story, the cash flow statement is the lie detector. And I don't mean a lie in terms of like Adobe lying, but accounting principles and the way you have to report things on the income statement can sometimes obscure the reality of how cash moves through the business. Adobe, for example, has a lot of amortization of intangible assets, and that is not like a cash expense. It doesn't cost the business anything, and it doesn't necessarily tell you the quality of the business from a cash flow perspective, which really matters. So let's just look at the consolidated statement of cash flows and see what stands out. Again, I think importantly, this is like really good. This is sort of like almost like an offset to what we saw on the income statement, where the net income was sort of worse than it actually looked on the surface. This net income here will tie exactly to the income statement. And then basically what they do is they add back the non-cash items. So again, depreciation is there, stock-based compensation, et cetera, et cetera. And really what this does is it sort of compensates for what we saw with the net income dropping so much due to that Figma termination. Is we can still see here that the cash flows are increasing and Adobe still looks really, really strong from an operating cash perspective. So that's super important. And then the other thing that really stood out to me is just the quantity of share buybacks that is going on with Adobe. When a company spends cash to buy back their shares on the open market, what they're doing is really returning capital to the shareholders because the value of the shares that I own goes up in proportion to the restricting supply of shares on the market. So Adobe is spending $9.5 billion in FY24 to repurchase shares, $11.28 billion in FY25 to do so, and then they've also authorized in FY26, we'll get into this a lot later, but for FY26 and beyond, they've done another authorization of like $25 billion. So that's not to say that's going to happen. Authorization of share buybacks doesn't mean it's going to happen, but they sort of have the room if they want to spend another $25 billion buying back share prices because they feel the current price of Adobe is undervalued compared to the business. It's always a little bit of a risk when a company does share buybacks because a lot of times management gets it wrong. They buy the shares back at a high price and then they raise capital at a low price. And that is basically destroying value for shareholders, right? It's the same as you as an investor. If you buy shares at a high valuation and then it comes down, you're losing money essentially. And the data sort of shows that management teams tend to do the same. So that's always the risk with share buybacks versus like a dividend where they're just putting cash in your pocket. But for what it's worth, Adobe feels that the current share price, which is like around $240 right now, is undervalued. So what I've done here is calculated a couple metrics to help us understand the cash flow of Adobe a little bit more. So the first is the free cash flow conversion. This is essentially understanding how much of the net income is coming from cash from operating activities. So if the net income is $7 billion, their cash from operating activities is $10 billion from up here, their free cash flow conversion is 141%, which is outstanding. I mean, basically every number we look at here is gonna be outstanding. And the real interesting discussion will come in later videos when we talk about like the future. But Adobe just really is a fantastic business. Their free cash flow margins, this is the percent of revenue that free cash flow is. Again, 41% and increasing. And then the adjusted free cash flow margins, this is me taking the Figma acquisition portion out of it. So basically, instead of it just being up the whole time, it's up in FY24 and then flat in FY25. So again, something to keep in mind, it's not growing, it's not as positive as it looks necessarily, but it is still super strong. Okay, I don't think we need to go over that because I've sort of already explained it. So now let's go and let's look at the balance sheet. So the balance sheet is like the health snapshot. Income statement is the story, cash flow is the lie detector, and balance sheet is the health snapshot. It's like when you go and you get your blood tested and it sort of tells you how healthy you are in the moment. That is what the balance sheet is. So lots of interesting things to unpack here. I've sort of narrowed it down to some of the key items that I think are important to look at for Adobe. So you can pause it and take a look here. But the other thing that I just want to sort of point out here is in this current liabilities bucket, this has a whole bunch of things in it. And one of the things that is in it is the deferred revenue, right? That's in the current liabilities. Deferred revenue is not always a dangerous liability when we think about it. Liabilities we sort of think about as like debt. It's like an obligation to someone else that you have to perform. That's why deferred revenue goes in here, right? It's like customers that have already paid for Adobe services, but Adobe has not fulfilled that performance obligation. But it's also not necessarily what we want to look at when we're trying to understand, like, is Adobe gonna go out of business if they have a lot of debt and they can't pay it back. So for most of the key ratios we look at, I'm kind of adjusting that out of it because I think it gives a little bit of a better picture of how healthy it is. So for example, if we look at the current ratio, which is their current assets over their current liabilities, it's under 1. And under 1, I mean, it's just under 1, but under 1 is typically not a great thing. It means that they have more liabilities due in the next year than they have current assets due in the next year. That would be like worrying if not a lot of it was deferred revenue, which Adobe doesn't have to do a whole lot to fulfill the performance obligation. They just have to let you use their software basically, right? So if you adjust that out, it's actually closer to 3, which is really, really strong. Basically, there's no risk of Adobe going bankrupt in the next year whatsoever, especially because of all their cash flows that they collect over the year. It's just not going to happen. The other thing that's good to look at is their short-term debt. This is like actually pure debt that they owe. Their short-term debt is literally 0. And then I think that, and most people would say, that you should include the current portion of their leases in the calculation as well, because leases are kind of like debt, right? Like if you sign a lease to an apartment, you have to pay your rent. It's basically debt. So Adobe's is only 77 million, which is really low for a company that generates 10 billion in cash every year, basically immaterial. And then the net debt is sort of like the aggregation of all of this, where we take the short-term debt, we take their long-term debt, and then we look at their cash and basically say, do they have enough cash to cover all of their debt? And if it's a negative number, it means they have more cash than debt, which basically just means it is in like a super strong position. And there's, again, no risk of it really going bankrupt whatsoever. So basically, you could feel like assured in owning the business that it's not going to go bankrupt. So I think the takeaways here is that the balance sheet is basically a lot stronger than it looks on first glance because of that deferred revenue portion. And it's basically closer to like what they call a fortress balance sheet rather than like a risky business. It's not going to 0 anytime soon. And then so the question we're sort of left with after all this is not whether or not it's a good business. It clearly is an amazing business. It's whether or not it's still a growth stock, because that's how it's been priced. And if it's not a growth stock, has the market overcorrected, or has it not corrected enough and Adobe is going to continue to go down? And then if it has overreacted and overcorrected, by how much? Those are sort of like the things that I'm left with here. Okay, so let's just look at some valuations to their peers to sort of get an understanding of where we are in the industry, in the SaaS apocalypse, rather than just purely focusing on Adobe. So this is Adobe's historic valuation over the last 10 years from December 2016 to November 2025. And these are the metrics that, I wanted to look at. I'm not like a SaaS industry pro, but when I was researching the company, these are sort of the metrics that popped up as important to look at. So the first is the rule of 40. This is like less of like a valuation metric and more of like an operational metric, but basically what it is the revenue growth rate over the free cash flow margin. And it's kind of like an industry standard benchmark where when it's over 40, it's considered healthy and justifies a premium over any sort of other SaaS business. And we can see that Adobe has basically just always been over that 40 line. It did dip down to 46, which is still really good in December 2023. And then, it's just bounced back up in FY25 and looks really good. The other one is the price to earnings. I just like to include this because this is like the broad hammer that you can kind of use to evaluate a lot of different businesses against each other. And I like to just see it. It's generally better for mature and stable businesses, but it can be distorted for companies like Adobe with a lot of GAAP accounting expenses like share-based comp, which Adobe has, and amortization of intangible assets, which Adobe also has. Price to free cash flow ratio, that's another metric that I like to look at. It's basically like PE, but a little bit more honest for Adobe. It values the business against the cold, hard cash that the business generates for its shareholders. And then we have enterprise value over EBITDA. So this is a valuation that uses the value of the cash and the debt and the earnings before interest, tax, depreciation, and amortization, which sort of neutralizes those GAAP accounting expenses, and then allows us to get like a good level of insight between different businesses. So look, we can see basically by all metrics that Adobe is cheaper than it has been ever in the last 10 years. And this points to the fear that the industry has right now around AI and trying to really understand that despite all the amazing metrics that Adobe prints, is this still a growth stock? And is it going to keep being a growth stock going forward? So here again, we can look at those metrics compared to its peers. The app that I'm using doesn't let me add the rule of 40 to it, or maybe it does and I just can't figure it out, but I've just recalculated all of it so that you can see it. So again, Adobe compared to peers on EV to EBITDA, it's the cheapest. PE ratio compared to its peers, it's the cheapest. Free cash flow margin, it's the best. Return on invested capital, it's the best. Price to free cash flow, it's basically the cheapest. Oracle, I mean, kind of is lower, but it's in the negative, so that's like a completely different discussion. But there's a whole lot of context around it, so we can sort of just ignore that for now. And then for year-over-year revenue growth, it's kind of in the middle. For Rule of 40, again, it is the best. Basically, against all its peers, it appears to be the most undervalued, I would say, with the best free cash flow, best return on invested capital, which we'll talk about a little bit more later. But again, I would say that most of these businesses have a majority enterprise customer base. It is something to keep in mind going forward. AI might apply a little bit more pressure to Adobe. And that is really what we're going to talk about next in the next video. We're going to look at the business as a whole, and we're going to analyze the entire moat and how Adobe competes in the marketplace against Canva, other VC-funded creative apps, and how they're currently competing against AI tools. We're not going to go over this in this video, but you can see we're going to talk about pricing power, switching costs, network effects, intangible assets, and cost advantages. So if you're interested in seeing that, subscribe, like this video if you thought it was useful, go back and watch the first one. If you still haven't done that, you should do that, and I'll see you in the next video.